Hello everyone and welcome. Today, we're going to explore the Fortress Portfolio, a strategy specifically designed for the thoughtful investor who values security and long-term growth. We'll be synthesizing timeless insights from investment legends like Seth Klarman and Warren Buffett, combined with robust fundamental analysis, to show you how to build a portfolio that stands strong, much like a fortress, against market volatility. Let's start by understanding a crucial distinction: the great divide between investing and speculating. An investor buys businesses. They focus on consistent cash flow, view stocks as fractional ownership in real companies, and meticulously analyze business fundamentals. A speculator, on the other hand, buys prices. Their focus is on resale value, seeing stocks merely as ticker symbols, driven by market demand and the greater fool theory. Think of the trading sardines. Anecdote: sardines were traded at high prices until someone tried to eat them and found them rotten. The seller's reply? Those weren't eating sardines, they were trading sardines. It perfectly illustrates how some chase price momentum, not true value. For a secure financial future, we must be investors, not speculators. Now, let's talk about the enemy at the gate: Wall Street's often conflicting agenda. It's vital to understand these biases. First, the upfront fee bias. Wall Street often profits whether your investment succeeds or fails, as they get paid on the transaction itself. Then there's the bullish bias. Analysts are often incentivized to issue buy ratings, sometimes to support underwriting clients, rather than providing truly impartial advice. Finally, we see innovation for fees, where complex financial products and IPOs are created primarily to generate commissions, not necessarily to create lasting value for you, the investor. This insight, drawing from Seth Klarman's critique, reminds us to be vigilant and always prioritize our own interests. This brings us to the architect's rule: engineering a margin of safety. This is a bedrock principle. The margin of safety is simply the gap between the price you pay for an asset and its intrinsic value. It's your buffer, your protection against bad luck, analytical errors, or an unexpected economic downturn. Think of it like a bridge designed to hold 30,000 pounds, but you only put 10,000 pounds on it. That extra capacity is your safety margin. As Warren Buffett famously says, rule number 1: never lose money. Rule number 2: never forget. Rule number 1. A substantial margin of safety is how you achieve that. As Seth Klarman puts it, it's about purchasing securities at prices sufficiently below their underlying value to allow for human error. To build this fortress, we need a blueprint. This is our 10-point checklist for selecting blue-chip companies, those truly strong, reliable businesses. This filter helps us cut through all the speculative noise. We'll focus on 4 key pillars. First, stability, ensuring the company can survive any storm with conservative debt and strong cash flow. Second, profitability, confirming the business engine runs efficiently with high returns on equity and widening margins. Third, a strong moat, meaning a durable competitive advantage that fends off attackers, like dominant market share or brand loyalty. And fourth, excellent management, with competent leadership demonstrating radical transparency and wise capital allocation. Let's dive deeper into each. Pillar 1 is the bedrock of financial stability. This is non-negotiable. We look for companies with a debt ratio below 100%, ensuring they're not over-leveraged. Their current ratio should be over 200%, indicating ample liquidity to meet short-term obligations. An interest coverage ratio greater than 10x provides a massive safety buffer for their debt payments. And critically, we verify stable cash flow, proving that the money is real, not just an accounting entry. As the saying goes, a company that cannot go bankrupt is the only kind that can compound indefinitely. We want enduring businesses that will stand the test of time. Pillar 2 is the profit engine. This is about how efficiently a company generates earnings and uses its capital. We look for operating margins above 10%, indicating strong efficiency in its core business. We also want a return on equity, or ROE, above 10%, showing effective capital usage. Here's a crucial distinction from Warren Buffett. In 2024, he warns that net income can be capricious due to unrealized capital gains. The true measure of a company's health is its operating earnings, profits from its actual business operations. For example, Berkshire Hathaway generated $47.4 billion in operating earnings in 2023, a clear sign of a powerful profit engine at work. Pillar 3, the economic moat, is what truly protects a company's returns. Just as a moat protects a castle from siege, an economic moat shields a business from competition. Key components include dominant market share, high barriers to entry for competitors, and pricing power, which allows a company to resist inflation and pass on costs. Think of fortress examples from Buffett's own portfolio: Coca-Cola, with its unparalleled brand power spanning generations, or American Express, with its powerful network effects and deep customer loyalty. These companies possess durable competitive advantages that are incredibly difficult to replicate. Pillar 4 is the captain of the fortress, the management team. First, we demand radical transparency. CEOs must report clearly and honestly, avoiding what Charlie Munger called thumb-sucking, procrastinating on fixing mistakes. As Warren Buffett stated in his 2024 letter, it's about reporting mistakes and correcting them quickly. Second, we look for wise capital allocation, rational dividends, and intelligent share buybacks that benefit shareholders. It's reassuring to note that Greg Abel, identified as Buffett's successor, is carrying forward this culture of transparency and prudent capital allocation, ensuring the fortress remains in capable hands. Let's look at the fortress in action, with a real-world example: the Japanese trading houses. In 2024, Warren Buffett invested significantly in companies like Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. Why did they fit his blueprint? They offer extreme diversification, operating as conglomerates similar to Berkshire Hathaway. They were purchased at attractive prices relative to their robust cash flow. They are shareholder-friendly, engaging in smart dividends and buybacks. And critically, their dividend yield exceeded their financing costs, creating a positive spread. The outcome? These companies are profiting from what Buffett calls the American tailwind and the stability of global commerce, demonstrating how these principles lead to powerful results. Now, let's uncover the secret weapon: insurance float. This is a concept central to Berkshire Hathaway's success. Here's how it works: insurance companies collect cash upfront in the form of premiums and then pay claims later. This creates a massive pool of capital, or float, that can be invested in other businesses in the interim. The key insight here is the discipline of risk. As Buffett notes, optimists are not suitable for the insurance business. You must price for worst-case scenarios, considering factors like climate change and accidents, to ensure that float is truly a benefit. For instance, Geico's strong performance was a primary driver of Berkshire's $47.4 billion in operating earnings in 2023, showcasing the power of this strategy. This brings us to the long siege, the Methuselah technique. It's all about the incredible power of compound growth. Unlike linear growth, where returns are added simply, compound growth means your returns also earn returns, creating an exponential effect over time. Imagine investing just $1,000 at a 10% compound interest rate. In 50 years, that initial $1,000 doesn't just become $6,000, it grows to over $117,000. This concept is investing with a truly long-term timeline, allowing the magic of compounding to do the heavy lifting. As Benjamin Graham wisely stated, the market is there to serve you, not to instruct you. Patience is a virtue, especially when it comes to compounding. So, let's distill this into the rational investor's creed. These are your guiding principles for building a secure financial future. First, reject speculation, ignore the sardine traders and the temptations of Wall Street fees. Second, demand safety, never build your portfolio without a substantial margin of error. Third, trust the blueprint, use our 10-point checklist to verify true stability and durable moats in the businesses you invest in. And fourth, embrace boredom, let compounding do the heavy lifting over decades. This isn't about excitement, it's about steady, predictable wealth creation. In closing, this is an invitation to discipline. True wealth is not primarily a product of luck or even a high IQ, it is, more often than not, a product of temperament. It requires patience, a calm demeanor, and the ability to think independently. We encourage you to adopt the mindset of a business owner, carefully evaluating the companies you invest in, rather than simply being a ticker symbol trader chasing fads. Embrace this disciplined approach and build your own financial fortress that will provide security and prosperity for years to come. For those of you who wish to delve deeper, here are some excellent sources and further reading. Seth Klarman's Margin of Safety is an absolute classic. Warren Buffett's annual shareholder letters, especially the 2024 edition, are always full of wisdom. And of course, a solid understanding of fundamental analysis and blue-chip checklists is invaluable. Thank you.